Good afternoon. Today we are going to talk about expectations, exchange rate and capital account. At the very outset, we will discuss the open interest parity condition. Once we have discussed that, then we will relook at the foreign exchange markets. So, that is the plan for today, and then once we relook at the foreign exchange markets, we will also see the impact of expectations and interest rates on the exchange rates. So, let me come back to the open interest differential. So, if you have 1 rupee today, at the end of the year, the return that you would get would be 1 plus r. But if there is a possibility to take this 1 rupee outside and invest it in foreign country, okay, and then earn the foreign interest rates and then bring back the money from the foreign country, one needs to work out the open interest differential. So, if this 1 rupee, if it is converted into say US dollars, it will be 1 by pi. The rate of interest that it will get will be r star. So, 1 rupee converted into US dollars, so it is worth 1 by pi. The interest rate that it gets is r star. So, this is the amount of money in US dollars at the end of the year. Now, if we want to bring this money back to India, we need to convert it back into Indian rupee. So, we do that by using an exchange rate. This is called the expected exchange rate after a year. So, then if we compare this with the return that we get in India, and if this is greater than 0, then your investments in foreign bonds is profitable. If it is less than 0, then it is worthwhile for the foreigners to invest it in the domestic bonds. So, then you define pi hat, which is the expected rate of change of exchange rate equal to pi e minus pi by pi. Pi, you know, is the unit of domestic units for a unit of the foreign currency. This is pi. Pi expected is the expected exchange rate after a year's time. So, then from here 1 by pi 1 plus r star pi hat pi plus pi So, the open interest differential works out to be pi hat plus r star minus r. If it is greater than 0, then your investments are profitable. What it means is that in the foreign country you may have lower interest rates as compared to your own country, but still it may be profitable to invest in the foreign country if the expectations are that the foreign currency will appreciate. So, even though it is giving lower interest rates, R star is lower than R. Okay. So, we are going beyond the Mundell-Fleming framework. We are going beyond the Mundell-Fleming framework, where we said capital is a function of the differential interest rates. So, here you can have a situation where the foreign interest rates are lower than the domestic interest rates, but it is still profitable to invest in the foreign country, because you expect the foreign currency to appreciate or domestic currency to depreciate. So, then the real returns are pi hat plus R star minus R, which is greater than 0. So, the investments become profitable. Now, further you assume that each investor or speculator is either risk neutral or he is risk averse. If he is risk neutral, then he considers domestic and foreign bonds as perfectly substitutable. So, look at this differential in the wake of all investors and speculators like us being risk neutral. In other words, it means that you consider domestic and foreign bonds as perfectly substitutable. Now, if you assume that domestic and foreign bonds are perfectly substitutable, as soon as you find there are gains in investing in foreign bonds, you would, if you are a risk neutral person, you will completely switch out of domestic bonds into foreign bonds. Completely switch. If you are risk averse, you will not completely switch from domestic bonds to foreign bonds, but because you are risk neutral, which means that domestic and foreign bonds are perfectly substitutable, you completely switch out of domestic bonds and you put your money entirely into the foreign bonds. So, please see what happens to this open interest differential. It does not remain as differential, because the foreign interest rates go down, because you start demanding foreign bonds, the price of bonds, foreign bonds goes up, the interest rates go down, the foreign interest rates go down, the domestic interest rates go up because the money flows out of India, and then pi hat, which is pi e minus pi by pi, the foreign currency appreciates or your domestic currency depreciates, because you start demanding foreign bonds, you start demanding, you need foreign exchange. When you need foreign exchange, the demand for foreign exchange goes up. When the demand for foreign exchange goes up, and this being a flexible exchange rate regime, pi goes up. So, this pi hat goes down. Eventually, you see pi hat plus R star minus R to be equal to 0, or pi hat to be equal to R minus R star. This is the famous open interest parity. This is the open interest parity. This is an equilibrium condition. There are no arbitrage opportunities available. So, you have the expected rate of change of exchange rate to be equal to the differential interest rates. There is something like a covered interest differential or a covered interest parity. We will discuss that. There is not much difference, except that this pi e that we have here, you replace pi hat with delta, which is the forward premium, which is pi f minus pi by pi. This is the forward rates. If you work on similar lines, you would get something like delta is equal to R minus R star. This is the covered interest parity. So, in case you in the economy you have both open interest and covered interest parity, you would have pi hat to be equal to delta, which is pi e minus pi by pi is equal to pi forward minus pi by pi. This would mean that the best predictor for the expected exchange rate is the forward rates. Remember, the forward rates, those are rates which are determined today for a transaction which is done, say, tomorrow or in future. So, the best predictor of the expected exchange rate is the forward rate.
So what is the difference between this? Even pi is the expected rate to be obtained.
Yeah, but expected exchange rate you don't know, you don't have data for it. It's like, what will be the exchange rate, India US dollar exchange rate after a year? Pi expected. There are no proxies. So, it says that if these two hold, then the best predictor of pi I is the forward rates. Okay. So,
But isn't forward rate also kind of expected rate tomorrow?
yeah, but you have data for it because you have markets for it, and we will see once we discuss the foreign exchange markets, we will go to the forward markets. Again, you have a demand for it, you have a supply for it, and then it is determined. The forward rates are determined. If the forward rate is greater than the spot rate, you say that the foreign currency is in premium, is sold in premium. If the forward rates are less than the spot rates, you say that the foreign currency is sold in discount. So, we will come to the forward markets, but then if you have to do some empirical work on this, then what people do, researchers do, is they run a regression. Pi e, they would say it is the rate of change of the spot rates. So, they proxy this for the change in the spot rates, A plus B pi forward, and then they test the hypothesis A is equal to 0 and B is equal to 1. Joint hypothesis or that A is equal to 0 and B is equal to 1. So, this as change in the spot rates is a poor proxy, but this as a proxy for pi e, these are available. A is 0, this is joint hypothesis. If you know econometrics, if you have a joint hypothesis, then you can apply the F test. There is an F test which says restricted residual sum of squares minus unrestricted residual sum of squares divided by number of restrictions divided by unrestricted residual sum of squares n minus k, where k is the number of parameters. So, you can have a restricted model, restrictions being A is equal to 0, B is equal to 1. You will have a restricted model. So, the residual sum of squares from the restricted model, restricted residual sum of squares minus URSS divided by the number of restrictions, divided by URSS divided by n minus k, where k is the number of parameters. You can check whether this holds. Of course, after estimating the equation, you can do the hypothesis testing. So, this you can simply you can take this up in your research study, the paper that I am asking you to do. You can get data on the spot rates, you can work out the changes in the spot rates, you can get data on the forward rates. Just run a simple regression. If you do not want to burden yourself much with this type of research work, just get this data, run a regression and check for these two hypotheses. Okay, now as I said, we will relook at the foreign exchange markets through something which are called the excess demand and the excess supply curves. We are now re-looking at the foreign exchange market. Earlier, when we looked at the foreign exchange market, we had the demand for foreign exchange, which was the usual downward sloping demand curve, and we had the upward sloping supply curve of foreign exchange, which came from the demand of our own currency in the foreign markets. So, when the foreign currency appreciated or our domestic currency depreciated, and you had assumed that that foreign demand curve is elastic, in that case you got an upward sloping supply curve. Please recall that this supply of foreign exchange is coming from, while this is India, this is the foreign country. So, you have 1 rupee in terms of foreign currency, and you have a downward sloping demand curve there in the foreign country. So, think of a scenario where the foreign currency appreciates, or in other words your currency depreciates. When your currency depreciates, the demand for the Indian rupee goes up. Remember depreciation, the price of your own good in terms of foreign currency, it comes down. So, the demand for your goods would go up, and because you assumed this to be an elastic curve, the revenues would go up because of the decline in the prices. This is elasticity. I have used the concept of elasticities. So, if the value goes up, this is equivalent to saying that with an increase in pi you tend to supply more of foreign currency, because only when the foreigners demand more of your currency, then only they will supply more of foreign currency. So, this upward sloping curve is coming from this downward sloping demand curve for our own Indian rupee in the foreign country. So, then the equilibrium exchange rate was wherever the demand would intersect supply, that was the market exchange rates, and this was the equilibrium demand and supply of foreign exchange. Now, what is excess supply is that if pi goes up, if pi goes beyond pi star, then you can see what happens. You have a disequilibrium situation where the supply of foreign exchange is greater than the demand for foreign exchange. You call this excess supply. And the reason that this is happening is because if pi goes up, there is appreciation of the currency, appreciation of the foreign currency or depreciation of the local currency. There is an excess supply of foreign exchange because something happens in the economy. That something is that Marshall-Lerner condition gets satisfied. Remember Marshall-Lerner condition? A depreciation or a devaluation will improve the current account balance if the sum of the home and foreign import demand elasticities is greater than 1. So, we are assuming this upward sloping excess supply curve with a upward sloping ES curve, assuming that the Marshall-Lerner condition holds, and if pi increases beyond pi star, the excess supply increases, because as the foreign currency appreciates or your currency depreciates, you see an improvement in the current account balance. So, this ES curve is drawn under that assumption. So, it is like the supply curve, right? Higher the price, higher the supply. The only thing that you are assuming is that the Marshall-Lerner condition holds. So, depreciation leads to an improvement in the current account balance, or you have a balance of payment surplus. Then you have a downward sloping ED curve. Now, this, while excess supply was the supply by the other market participants, this ED curve is the demand put by the investors and speculators, and it is downward sloping because these investors, speculators, they are interested in profitable investments. So, think of a situation where the pi is this, where ED is equal to ES is equal to 0, there is full equilibrium. If pi goes below this, if pi goes below this point, see what happens. Initially, you had r is equal to r star, pi had to be equal to 0 because pi is equal to pi. This was the point which would show that the open interest differential was 0, because r was equal to r star, pi hat was 0, pi hat was 0 because pi e was equal to pi. Now, let us assume that pi goes down. So, when pi goes down, this pi hat increases. So, you see a positive open interest differential. So, when you see a positive interest differential, the investors, speculators expecting depreciation of the currency would like to, depreciation of your own currency or appreciation of the foreign currency, would like to now demand more of foreign currency. So, as you come down, you see a positive excess demand, because pi hat goes up, open interest differential is greater than 0. So, you would like to invest it in foreign bonds because you expect your currency to depreciate or foreign currency to appreciate. You are a speculator, you are an investor, so you would like to invest in the foreign bonds. So, that is the reason that you have a downward sloping ED curve, but there is another reason. Another reason is that it is downward sloping because you are not risk neutral in this case. You are a risk averse person. When there is an open interest differential in favor of you, you do not completely switch out of your domestic bonds into foreign bonds. What would have happened if you had completely switched out of your from domestic to foreign bonds? What would have been the shape of the ED curve? It would have been a horizontal line. But because you are risk averse, you do not consider domestic and foreign bonds as perfectly substitutable. you do not completely switch into the foreign bonds. So, this ED curve is downward sloping because you are risk averse, and when the open interest differential is greater than 0, then as a speculator investor you would like to invest in the foreign bonds. So, you are rational in that sense, you want to have more profits. What would have happened if pi would have gone up? If pi would have gone up from this situation where r was equal to r star, pi hat was 0, and then pi instead of going down goes up. So, pi hat would have gone down. Then it would have been the foreign investors who would have liked to invest in R bonds. Okay. So, the excess demand would have come to be negative in that case, because it is the foreigners who are putting up the money. Supply is greater than our demand. So, then you see negative ED if pi goes beyond this point. All right, so you have the ED curve, you have the EC curve. This is the initial situation, it is an equilibrium condition, open interest differential is 0, and so ES, ED is 0, ES is 0, it is equilibrium. Now, let us see two things happening, the impact of an increase in there is an increase in foreign interest rates. If there is an increase in foreign interest rates, this was the situation in equilibrium. Now, this goes up, R star goes up. So, if R star goes up, there is an open interest differential, the ED curve will shift because it is like a shift factor. There is an excess demand for the foreign currency, and that is matched up by the increase in excess supply, because if the pi goes up and if the Marshall-Lerner condition holds, then that excess demand for foreign currency is met by the other market participants, they supply the necessary foreign exchange. So, you come to an equilibrium from this, you reach to another equilibrium which is point B, where the increase in excess demand is matched by an increase. At point B, you can see that the open interest differential holds, because phi hat is pi E minus pi by pi. If you had reached a point like C, here open interest differential would have been 0, but at point B there is an open interest differential, which means that there is an excess demand for foreign currency which is met by the other market participants who supply the necessary foreign exchange. So, this is quite simple, you have increase in interest rates, foreign interest rates, the ED curve shifts. Second is a more interesting case, where you bring in expectations. So, I am going to redraw this curve. So, if you look at the handout, I think it is better that we look at the figure 16.3 here in the handout. This is the effects of change in expectations, and I am talking of figure 16.3. Now, see what happens. You are expecting that in future the imports will go up. Okay. So, you are expecting this pi e, you are expecting this pi e to go up, maybe because you expect that there is global recession all over. Our currency may depreciate in future. We are not going to get enough orders from the foreign country. So, you expect your currency may depreciate in future. That is like saying that your ES curve shifts up to E star S star. So, you anticipate, you expect that the ES curve will shift up. That is, in other words, you expect this pi e to go up. Okay. So, here I am bringing expectations. Your expectations are that country's expectations are that your currency may depreciate in future. In this diagram, it means an upwards, you anticipate that the ES curve will shift up. You fully anticipate that your ES curve will shift up. So, that pi e goes up. Now, from this scenario, as soon as the pi e goes up, you have pi hat going up. When pi hat go up, there is something which happens to the ED curve. Remember, the speculators, investors, as soon as they see a positive open interest differential, they would like to put their money into foreign bonds. So, their ED curve, the ED curve shifts to the right. Now, see what is happening. If you think you expected, underlined, you expected your currency to depreciate, but then in reality your currency in fact depreciated. You only expected that maybe after a year's time your currency will depreciate. What happens is the self-fulfilling type of prophecies. If you think that there will be depreciation in the markets, there you saw depreciation happening. So, that expectations, that if you have that expectation that I will do good in my exam, and then you actually do it at that particular moment, that is something what what happens here. So, you were expecting that currency will depreciate after a year's time, but then it did depreciate immediately because the ED curve shifted to the right. This ES curve which comes with a dotted line is you had anticipated, it is not the real shift of the ES curve. You had thought that okay, your currency would depreciate in future, but then what it does is, because there is an open interest differential, pi hat goes up, the ED curve shifts to the right, and your currency moves, your exchange rate moves from P to P dash. Your currency depreciate or their currency appreciates, but then it does not reach a point like P star. Reason again because you all investors, speculators are risk averse people, they will not completely switch from domestic to foreign bonds, but at least speculators know that their currency has reached P dash. They are speculators, investors, they know that they can buy the currency at P dash and sell it maybe at a future rate at P star. Okay. Now, expectations can bring stability in the foreign exchange market. This is a strong statement I am making. Expectations, generally you say speculators, they have expectations, it is bad for the foreign exchange market, but let me bring in this point that here, if in reality the ES curve indeed shifts to E star S star after a year's time, then it brings stability in the foreign exchange markets. Reason? Because earlier your exchange rate was P dash, it was expected to go further to P star, that means foreign currency would appreciate, your currency would depreciate. You had expected investors to buy currency at P dash and sell it at P star, and if indeed ES curve after a year's time shifts to E star S star, it brings stability in the foreign exchange markets. If in actual practice that ES curve would have remained ES, in that case only it would bring instability in the system. So, you have both. If ES curve indeed shifts to E star S star, then it brings stability in the system, and if ES curve would have remained at ES, then it brings instability in the system. Then you may ask that if you are a speculator or investor, you would be in the business only for making profits. So, in other words, you would only expect that there would be only stability in the system due to this changes in expectations. To answer that, one needs to think that these decisions have to be made quickly. It is not that you can just sit on these decisions. So, you may go wrong. If you are expecting that you are a rational person, you would be in the business only for profit motives, and it would always bring stability. That argument will not hold, because all these decisions are made, you have to make it quickly. So, you may go wrong in that context. So, this particular example shows that if you had fully anticipated the changes in the ES curve, and if the actual ES curve did change to E star S star, it brings stability in the foreign exchange markets. Now, this indirectly leads to these the financial crisis that we saw in Europe, in these two countries, say Sweden and United Kingdom. There the market participants felt that after the Maastricht Treaty, when every country was fixed, they fixed their currency to euro, they expected that their currency will depreciate in future. And it did depreciate immediately, because if you start feeling that there is something wrong, then really something wrong happened. So, this is like the second model of financial crisis. It is like self-fulfilling prophecies. If you expect that there will be a depreciation, then indeed there will be a depreciation taking place of your currency.
But through different mechanisms.
Through different mechanism, the trigger would be something different. For West Germans, they were uneasy because these East Germans were coming in. The United Kingdom, because now its currency was pegged to euro, and remember the trilemma that we talked of, it had this uneasy feeling that we would lose our monetary independence, and that too for a currency that we had owned, the pound, the big pound. So, they felt that that probably maybe in future they would see a depreciation of the currency, and that builds up here in this open interest differential. The speculators start thinking, oh, it means that in future our currency would depreciate, foreign currency would appreciate, let us start putting the money in the foreign bonds today only, and that leads to the depreciation of the currency. Okay, I will end up here, and we will move to some other aspects of the same spot foreign exchange markets, and then we will move to the forward markets in the next lecture. Thank you so much.